Hi traders, a few technical issues there. Apologies for that. Welcome to this week's webinar, the Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. So this is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. Quite a lot to get through, actually. Quite a few interesting things happening, of course, to kick off markets really in the new year. So we'll look at just Venezuela really and oil, what's happening there. A few thoughts on that, and broad thoughts really about the dollar as well. We'll then look at stock markets, see how they've been trading in the new year. Obviously, we had Friday as the first day, really, and then this is the first full week. So we'll just give some observations, really, some thoughts about what's happening in US stock markets there. Still lagging, really, is the point against the rest of the world, which isn't often said and has been, and we pointed out last week and a few weeks before that, really, with a chart just showing you how US stocks have underperformed various other stock markets around the world. So we'll just highlight that point again. We'll then get into just some of the data actually we saw over the holiday period, US GDP, and a couple of thoughts around that. Quite interesting, really, we think. And we've got a chart there before then looking at the main event of this week, which is the non-farm payrolls data on Friday. So we'll look at that and have a few the graphic around that. We also have some inflation data out of Australia and the Eurozone, and also potential nomination announcement of the next Fed chair. So quite a lot to get through. Here is pretty much what we're looking at. So first up, really, is oil and Venezuela before we get to that chart, actually. So let me just grab the oil chart, really. I should say, if you do have any questions along the way, please do ask those, whatever they are, whatever we're talking about, whatever you're looking at. Please do ask any questions along the way. Let me just grab, as I say, the oil chart first up, which is here. So obviously, we've kicked off with this US intervention in Venezuela over the weekend, grabbing lots of media headlines, attention, but not really that much of markets. The key point here is that geopolitical events really rarely impact markets on a lasting basis. That is the key point for us. But obviously, we've had some reaction since markets have opened today. Haven assets like gold, silver, all rising this morning. But then so are some of the riskier segments in the market as well. So we've had Asian stocks, they surged 3%. Or up to 3% on the open, really led by Japan and the Nikkei 225. That's inches now, really, from its October 2025 record high. Oil prices, key, have sort of swung between losses and gains, really. And we're now pretty much little changed, I think, having been down around 1% or down over 1% or so earlier on in the morning, now back to flat and positive slightly. The dollar has mildly extended its recent sort of bottoming out process with an ongoing recovery, a gradual recovery, really, of the trade weighted index that kicked in since sort of Christmas Eve, just before Christmas there. And we've got a slight bid today, although that has come back slightly through the morning. Here's the oil chart that you can see. This is Brent crude. So you can just see that dip below $60, and now we're just above $60. So sort of downward, long-term downward trend, really inching towards this key sort of major support zone just above 58. You can see the spike low there from April, then also then in May, and then we dip down in the middle of December last month, close to that 58, so but not quite reaching it, sort of edging lower again. So really interesting whether this is this key huge support level, long-term support level, just above $58 in crude. Just in detail then, President Trump has obviously announced plans for major US oil companies to return to Venezuela and kind of refurbish its, severely degraded oil infrastructure. There are stocks which are rising. So Chevron, that's is the only US oil major operating in the country at the moment. That is up, I think, around 7% or so. And then ConocoPhillips and Exxon, there will be some focus on those stocks as well. Certainly, this intervention did catch markets off guard, but there's sort of near-term and long-term implications, really. Near-term implications we sort of highlighted really relatively steady. Venezuela's crude export is small, and regardless, there are no indications of any disruptions to production or sales. Um, the longer term impact is really sort of possibly more profound, but then clouded with more uncertainty. And that's why we're relatively calm. Of course, Venezuela holds a substantial untapped oil reserve, but certainly its production is far from pre-sanction highs. It will take, of course, huge investment and several years to reap any of those gains. Certainly, as well, Venezuela is a founding member of OPEC, so that means a production rise would have to be coordinated with the policy of the group. That would be interesting, certainly if it's, well, under Donald Trump's control, I guess. And then also, Venezuela would need to find buyers for its heavy crude. And if you look into crude, certain different types, light, moderate, really, and then heavy crude, which is certainly what Venezuela has most of, and is well, we there would need to be buyers for that form of crude. I guess more broadly, it's just around geopolitics and the dollar. That's the wild card, I guess. President Trump, he hasn't ruled out boots on the ground, and a more interventionist US foreign policy. Certainly, that could then hurt sentiment towards the dollar over time. It may then raise concerns over US fiscal strain, really, so budget issues there. And then it does just reignite possibly talk of diversification away from US assets by really BRICS aligned nations. That is a wild card, and as I say, a longer term, much longer term impact, really. Certainly, bottom line, really, I guess Venezuela does hold some of the world's largest oil reserves, but US policy actions have limited how much oil reaches global markets in the last few months at least. Any shift in sanctions enforcement obviously can quickly impact oil supply expectations and prices worldwide. While, of course, beyond oil, Venezuela's untapped critical minerals and rare earths, they add kind of another layer to the US China competition for future resources dominance, really. But bottom line, I guess, as I started this, is that geopolitics rarely impact markets for a long lasting basis. And that is really what we're seeing, although obviously haven demand, kind of haven demand along with, though, demand for equities as well. Silver, especially going higher, and gold two up, still up over 2%. So that's the old chart. Actually, let's get to gold because we should. Sorry, silver's up 3.25% now. Was up over 4% actually, so that's just come back slightly. Gold here, you can see previous highs at 43.80. We're just through that level now, having consolidated just below it after that big sell-off, having made that record high at 4,550, which is there from the end of last year. 50-day moving average, the blue line, well below here at 41.84. Otherwise, if we move on to stocks, just bear with me 1 second. I'm just pulling up the S&P, which is just off those record highs. I should increase this to that record intraday high, which was at 69.45. Let me just touch on that. Sorry, 1 second. I always like to make this accurate. Right. So, yeah, here's the S&P 500, of course, main benchmark broad-based US index. As I say, stocks on Friday, they started positively actually this year. That was the first full trading day, really, broadly confirming price action actually that we saw into the end of 2025. Really, headline indices they moved higher, but cyclicals, and this is the point really. That I wanted to make. Cyclicals underperformed defensives, driven almost entirely by weakness in the US and particularly US consumer cyclicals. Industrials stood out as the best performing sector on the first day, trading day of the year. Interestingly, the VIX was lower on Friday, but still has popped up slightly, but still remains around 15. Small caps outperforming large caps. And really, the summary there is that market tone remains risk on despite consumer cyclicals struggling in the US. But it is this continued underperformance of the US that we're seeing, and particularly large caps and especially large cap tech. They've lagged meaningfully in the sort of risk on markets in late 2025, and this pattern really still visible today in futures. Actually, risk appetite is there, but it's increasingly expressed outside US mega cap tech. So Asian markets, they were strong, as we said, not only in Japan, but also in South Korea and Taiwan. They were supported actually by solid PMI gains late last week. AI related themes are happening, but once again, they're gaining traction elsewhere. Outside of the US, so South Korea was up 3.5%, Taiwan up 2.5%, and that sort of move has not been mirrored in US futures. So they are up, but marginally so. And European stocks actually outperforming again, with the DAX making new all time highs. And this is despite Europe having already outperformed the US into year end. And on the first trading day of the year. So we concentrate on the US, but I should show you some other charts really as well. This is the S&P 500, that all-time high at 69.45. We're just below there with the 50-day moving average, the blue line being at 68.05. Excuse me. This is NASDAQ 100, similarly trading around the blue line, the 50-day moving average, which is at 25,236, all-time high back in October. So you can just see we haven't made one recently in recent weeks, whereas other major indices are performing around the world, as I've said on numerous occasions. All-time high in the NASDAQ, though, just for your guide, 26,182. We move to the Dow. Um, we have made all-time highs. That previous one was at 48,431. Intraday high from the middle of December, 48,886. And let me uh, just tidy this up. So yeah, that's the previous high, 48,886. We're not there yet, but looks like we could be making a move for that higher. Blue line is the 50-day moving average. Again, that's at 47,576. Let me just show you a couple of other stock markets. You've got the DAX, which you can see made an intraday all-time high, but has just pulled back to that previous level around 24,671, but the high was at 24,825 there. And then you've got the stocks, Euro Stocks 50 making new fresh all-time highs there, and the Stock 600 as well, pushing up to new all-time highs as well. So that's Europe, just for your guide. And again, just interesting, yeah, outperformance over US stocks here, just for your guide as well. Nikkei 225, nice sort of consolidation just above the 50-day moving average at 50,194, and we've pushed up very strongly now. And as I said, inches from that all-time high at 52. 636. Bullish momentum should really take that out soon, you would think. Okay, let's move on then from stocks. Or just before I move on, actually, I just want to show you one chart, which obviously reiterating my point really, but chart that we've shown you before. A lot of you have seen this over the last few weeks, but again, just this comeback for international stocks happened last year. and has sort of carried on going really. US equity premium sort of shrinking really. And if you think about the catalysts, interesting whether this continues and those catalysts continue. So Trump's isolationism and policy chaos, probably seen that in the first few days. We will potentially get fiscal measures by the EU and Japan. So markets hoping for those or in expectation of those, really. And then sort of AI, the spending spree, asset bubble really has ignited Asia's tech manufacturing hubs. So Taiwan, Korea doing well, especially last year. You can see that dark blue line is the Kospi, which is the South Korean stock market index, easily outperforming every other indices, major index, stock market index around the world. Um, and then also you've got sort of improving governance in some of the key emerging economies. And then whether it is just a classic case of mean reversion in valuations. Whatever it is, 2025, decent chart here, indexing these indices against the US, and the US, every other stock market really beat the bottom red, dark red line, which is the S&P 500. Okay, moving on from there to then just a few bits from last week, actually. So we had the FOMC minutes, they didn't really offer any big surprises. Participants' views remain divided on the outlook for interest rates, really. If anything, the tone slightly dovish, possibly, given that the discussion on risks was mostly focused on the downside risks to labour markets, and we'll get to that with the non-farm payroll preview. To quote, actually, though, upside risks to inflation remain elevated, but downside risks to labour markets were elevated and had increased since mid 2025. What I wanted to show you was just this chart actually, which was is from an investment bank, IG Investment Bank, and just on the back of the GDP figures out of the US, Q3 advanced GDP was very strong, 4.3% in Q3, accelerating 3.8. Although we will see a pullback certainly because of the government shutdown in Q4. This chart really just shows you how important, though, tech capex is right now, with computing and software investment contributing a third of the year on year 2.3% GDP growth. And you can just see that's the orange sort of marker here. So you've got the contribution from tech capex and then elsewhere, about a third that is now. I'm really interested in whether this or how likely or unlikely that is to change in the near term, given the fact that both government and the corporate sectors are aligned really and striving for US kind of victory really in the battle for AI dominance. I think that is really interesting and a really interesting question then potentially for the US economy and stock markets. The GDP figures, though, really did show us what is happening with this, what economists are calling the K-shaped economy. So if you picture a K, and notwithstanding the contribution from net trade, there's this sort of difference between in the household sector. So if you visualize a K, then the topward the upward move higher. That's the top 20% of households really by income, which continue to spend strongly, boosted by high income, soaring wealth, of course, with stock markets. And then the lower K, if you like, that's the bottom 60% who are really struggling really on concerns about job security and the potential for tariff induced price hikes. It all really goes a long way if you think about it to explaining why spending is still holding up, but confidence is so weak. Increasingly obvious in the corporate sector too, not just in terms of stock market performance, but also then business capex, capital expenditure, investment, essentially. So for 4 quarters in a row, business capex outside of tech has contracted, and that is really sort of recession style performance. But then investment in computing and software is up 18% year on year, which means overall business capex continues to rise. It's a really interesting detail, we think, there, and it contributes then to this chart on this that you're looking at. Certainly neither of these trends, so high income household spending and then tech capex, kind of they don't appear to be weakening, and in all likelihood, they could continue to propel growth in 2026. Obviously, potentially, if we do get a sell-off in stock markets, a very strong sell-off, then potentially that hits that top sort of 20% of households, and that then squeezes spending via negative wealth effects. Also, remember that the Fed data that shows the top 20% of US households by income own 70% of the wealth in America. So right now, that style of financial hit, if we did see a sell-off, would most likely really event and lead to a change in spending patterns. We think it's interesting, and that's why we're highlighting this to you, and it will be a theme going forward as we move through 2026. But just some thoughts on that briefly. Okay, let's move on from that to this week's main events. So we got US non-farm payrolls, of course. Here's a graphic with the main numbers released on Friday, of course. First Friday of every month, pretty much. Expectations for the headline to show 55,000 jobs added. That is slowing from the prior 64,000, but then the biggest drop in nearly 5 years in October after government-related spending cuts. Unemployment, that's expected to tick down to 4.5% from 4.6%. But really, the jobs data is expected to be relatively easier to interpret following the October reading. That was a negative headline of 105, and then obviously that 64,000 positive reading in November. Really, economists suggest that October's large decline in federal worker payrolls, down 162,000, actually was a one-off. And November's data showed a modest decline of negative 6,000. Also, expectations that November's government shutdown will now really hopefully have a diminished impact on the data. Ultimately, these numbers then for December will be used to set expectations, of course, for how the Fed will conduct its monetary policy in January. And that comes after, of course, the recent softer than expected inflation data, but then quite resilient economic growth data elsewhere. Many analysts' expectations, really market expectations as well, are for the Fed to pause. So yeah, at the moment there's around an 18% chance of a hike, so less than 1 in 5 chance that they hike rates in January, at the end of January. Of course, there are concerns over the softening labour market, and that has paved the way for the Fed to cut rates actually by a total of 175 basis points last year and in the previous year. But then we still have this persistent inflation uncertainty and tariff effects potentially that argue against any near-term follow-through. Kind of leaves things on a sort of data-dependent stance, really, rather than a preset course. But then, as I've put in here, markets do still expect more easing through 2026, just over, I think, 2 more 25 basis point rate cuts expected. But much, of course, will depend on the health of the labour market as inflation remains above its target, 3% around there, compared to the 2% target. Here you can just see that 55,000 relative, the headline print relative to the previous prints that we've seen. Obviously, that negative 105 October, and then the plus 64. Sort of outliers, really, in a way, or especially that one negative print due to the sort of government shutdown. So will be interesting now. We've got more clarity on the numbers. And then here, I've just got actually a print from Bloomberg. Actually, had opportunity to grab this screen, which again, don't want it to be too complicated, but you've got the different meetings down here. So 28th of Jan, 18th of March, etc. And then how many or the chance of a 25 basis point cut. So here they've got 19%. I said 18%. It depends how you look at it. This is actually from the 29th of December, but not too much change. So 19% chance of a 25 basis point rate cut. And then that's around 5 basis points or so. And then you can just see we have around 54, 55 basis points priced in by October. Um, and this is, yes, how Bloomberg puts this data from swaps and from futures. I will hopefully trying to be use these going forward as well, because as you can see, we have other market expectations on here as well. So UK, yeah, 10% chance of a rate cut in February, early February. Very little chance of anything happening in Europe. That's the Eurozone. And then RBA, interestingly, a 35% chance of a rate hike in early February. And Japan pretty flat. So yeah, we will be hopefully highlighting some of these figures going forward. Um, if we just look at the dollar now, actually, let me just pull up this chart, DXY chart, of course. Six of the US's main trading partners, with the euro being by far the biggest weighting in this index, 56% or so. I always say that, so just bear that in mind. You can just see this base that we said, although we do have downtrend, potentially just that medium-term downtrend being broken slightly. We've got the 100-day moving average at 98.59, and then we've got the 50-day moving average just moving above the 200-day, the black line, which possibly is bullish. Those come in around 99 or so, 98, 95 is a 200-day moving average. So interesting whether that proves resistance or not, or whether that's a bullish signal. Now the 50 days gone, risen up higher through the 200-day. We shall see. You've got this very long-term trend line from 2011, 2021 lows. If I just show you that quickly there, you can see that long-term trend line, which we've touched, and it has held it on a couple of occasions. So that's of interest there. And that comes in around 97.50. You can see before that long-term low at 96.21. We do have ISM data this week as well. Manufacturing out shortly today, and then services on Wednesday. Just for your guide, manufacturing expected to tick up marginally to 48.4 from 48.2, but still staying in that sub 50 contractionary territory. New orders could signal softening demand, while input costs always remain of interest and still remain elevated due to tariffs. For the services numbers, the manufacturing ISM forecast to move lower actually to 52.2 from 52.6. New business, that's likely to cool further as rising input costs and tariff-induced higher prices do hurt confidence, even though we will potentially, or expectations are for more rate cuts. Along with the dollar, there will potentially be the announcement of the Fed chair nominee. US President Trump has suggested he will name Chair Powell's successor early in the new year, so it could be this week. We shall see. CNBC, just for your guide, they reported the first week of January actually, and the list of candidates has greatly narrowed really from the 12 initially seen. For the most part, NEC director Hassett was seen as a clear favourite to replace Powell. But then in recent weeks, we've had several reports suggest that insiders are recommending against appointing Hassett, and his lead has diminished somewhat in betting markets, basically. Trump, he reiterated criticism of the current chair, Powell, for cutting rates too slowly. And he's repeated claims about, the Fed renovation costs and that kind of thing. The four candidates then now for your guide are Hassett, favourite at Polymarkets around 40%. Warsh then second favorite around 32%. Waller around 15%, and then BlackRock's Rick Ryder actually down around 4%. Waller, the only internal candidate, and the current chair, Powell's term expires in May of this year. So just watch out for headlines if we do get any thing about the Fed chair nominee. Otherwise, we get Eurozone inflation data, and I'm just pulling up the Eurozone Euro dollar chart. Sorry. Um, Inflation meant to still remain in a good place, really. So the headline is seen dipping 0.1% down to 2% year on year. That's exactly in line with the ECB's target, of course. And then core forecast to remain unchanged at 2.4%. That slight disinflation in the headline expected to be driven primarily by lower fuel prices, alongside a partial unwind of November's softness in, well, non-energy goods and firmness in services. That said, services inflation will remain closely watched by the ECB, given firmer than expected wage growth, which is meant to be happening soon, while authorities are also monitoring potential trade diversion effects from Chinese exports, and they have so far had limited impact on consumer prices. Certainly, though, not going to be a game changer you would expect for the euro. Dollar really driving this at the moment. Um, and a slight bid has seen, yeah, a few consecutive days now, 4 consecutive days of selling in euro dollar, and we're now just getting to the sort of 50-day moving average, the blue line at 116.37, and then the 100-day moving average at 116.62. Just below there is the 200-day, that's at 115.48. So just a rolling over really in euro dollar. And you can see that in other currencies like sterling, although it is holding up marginally and outperforming actually with a bid in sterling. Um, and interesting if we just moved then next to Aussie against the dollar, because we do get CPI data out on Wednesday from Australia. Previous release that showed CPI at 3.8% in October, up from 3.6%, while the trimmed mean, that's the RBA's preferred inflation gauge, that's at 3.3%. But certainly both those measures still well above the RBA's 2 to 3% target band. Let's not forget that. Inflationary pressures really, they've lingered late last year, contributing really to the ongoing debate about the RBA's policy outlook for this year. Recent RBA narratives suggested higher electricity prices due to the end of the government rebates actually are sort of biasing the annual inflation rate higher into mid 2026. But policymakers are looking at that, and they have signaled, of course, that they are prepared to reconsider rate moves if inflation does not subside. And as I showed you, around a 35% chance, 1 in 3% chance of a rate hike at their first meeting of the year in early February. We do get the quarterly inflation data actually out at the end of this month. So that will be more important really as a guide for the RBA. But certainly CPI data on Wednesday will be of interest. We're just hovering, interestingly. We were talking about this range, sort of 64, 66 range, long held range, broken to the upside, but then didn't last long. Now we're potentially out of that range, hovering bullish consolidation before potentially a move through 67, decisive move if we get it. Otherwise, we roll down with the 50-day moving average at 65.77. Okay, I'm going to wrap it up there actually. We've covered quite a lot, so hopefully that's been of use to you guys. No questions as I see it. So yeah, really hope yeah, it's been useful. Lots happening, of course, to kick off this year, kick off this first week really of the year. Please do follow us on social media. And also, I always say it, we publish a daily commentary after the US close every day on the website, just a look at the dollar, look at US stock markets, a look at the day ahead in a bit of detail, and also a chart of the day. Um, yeah, if you do have any questions, please reach out to us. Yeah, have a good week. We will speak to you the same time next Monday.